So good afternoon, everybody. It looks like a lot of people stayed. Maybe we have some new people as well. So Brian Tanner again. I am also the investor relations person for OSG as well. So for people that are joining us this afternoon, welcome. For those that remain with us, thank you for continuing to hang with us this afternoon. So couple of words, just as everybody knows, on the 30th, the separation went through. So, we have the two independent publicly traded companies. You heard from International Seaways this morning. Now we're going to hear from OSG's senior management team as they discuss strategies, performance, and growth opportunities for the OSG business. So let me turn to slide 2. Actually, it's 2 and 3. And direct your attention to the forward-looking statement, which will apply again to the presentations as well as our Q&A sessions. Most of you here were here this morning, but I'll repeat for the benefit of those that weren't, that when we get into the Q&A sessions, there'll be a couple of folks walking around with microphones, so be helpful to state your name and the firm, and make sure you use the microphone because that's helpful for the audience that's on the webcast as well. For those of you on the webcast, if you'd like to submit a question during the Q&A session, please email osg@capitallink.com. So the agenda for this afternoon is we'll begin with Sam Norton, OSG's President and CEO, and then move to Rick Arricchio, OSG's Senior Vice President and Chief Financial Officer. They'll detail the OSG story, and then we'll move to a Q&A session. So with that, I'll turn it over to Sam to get us started.
Push it forward and back. Thank you, Brian, and good afternoon, everybody. Thank you very much for coming. I wanted to take a moment to thank the organizers of this event. It's a very nice location, and hopefully you all had a nice lunch. It also, to me, it had a very auspicious start this morning when we came in here to look at the layout and try and understand how we're going to present to you today. And one of the principals that is running this organizer had introduced me to a young woman who was helping us in the beginning, and her name was Hope. And so we're standing around and we're trying to figure out how we're going to make all this work. And the response was, "Don't worry, Hope is on the way." So that's a good way to start this presentation. That Hope is on the way, and let's hope that resonates throughout. I think we can skip through these slides. You've met Rick. Rick has been introduced, and myself. This is a bit of an outline for how we want to try and take you through the presentation today. I think if I can leave you at the beginning with what I believe what we'd like to accomplish today, and maybe through the presentation and through the questions and answers as well. Is to give you a sense of how to understand our business, what it is that we think drives value in our business. Some of it is not necessarily immediately obvious. So we're going to delve a little bit into some of the distinctive qualities of the business that we have and the distinctive qualities of the markets that we participate in, to give you a little bit of a deeper dive into fundamentals and makeup of those elements of our business, and then we'll take questions at the end and hopefully be able to provide greater clarity on some of the things that maybe we didn't hit so well as we went through the presentation. As Brian just said, and just to kind of set the stage, OSG for many years was a combination of two distinct businesses. One was a domestically focused U.S. flag Jones Act business, and the other was an international tanker and in history, dry cargo and multi-purpose vessels, but in recent history has been focused as an international tanker business. We've chosen to split these two businesses for we think very good reasons and very compelling reasons that will allow each of those two independent businesses to pursue their own strategies and to create value that will be, in aggregate, the two halves will be greater than the original whole. The principal elements from OSG's perspective of why we think this is an important step for us to have taken is with the spinoff of International Seaways. What is remaining at OSG is a pure play Jones Act or U.S. flag, principally focused on the Jones Act business. So it's going to be easier now for us to focus on the specific qualities of that business and to be able to have the investor community like yourselves to be able to understand exactly what we're doing without necessarily introducing the complexities of the international spot, volatile, sometimes sexy, but nonetheless distinct from our business, which is, as we go through, you'll hopefully come to understand, is a much more stable, a much more industrial type shipping business, as opposed to the commodity-driven international business. The focus will allow a more streamlined analysis of this business, and hopefully we can give you some of the tools that we use to try and understand how that analysis would work. It also allows us to simplify our operating structure. We, as we go through this presentation, will refer to opportunities that we see in terms of adjacent markets or in consolidating some of the position in our existing markets. Having a pure, let's call it Jones Act currency in the stock that we have will almost certainly assist us in being able to pursue that in a much easier way than if we had the two businesses mixed together. People that are interested in holding our currency in the past maybe would have been reluctant to receive something that is containing an other exposure or another business that doesn't necessarily relate to the business that they're looking at. Once you remove that complexity, that currency tends, in my view, to look a lot more attractive to people that might present themselves in merger or acquisition opportunities. As I referred to earlier, it also enhances an ability for the investment community to understand our business. It's in many ways a much simpler business now. We operate only domestically. We have U.S. shareholders because by regulation because of the Jones Act provisions. We can address the audience to be a very domestically focused audience, and I think that will help us gain attention and gain traction over time. I also referred to earlier, ours is a much more stable business, and so I think we through the separation we remove some of the volatility of the business, and I think that will appeal to a certain investor class that maybe has been reluctant to look at OSG in the past because of the inherent volatility of the international, more commodity-driven business. I also want to point out that following the separation and through the work of all of those that were involved in the transaction structure and final execution, we've positioned OSG's balance sheet to be quite strong. We have a significant amount of liquidity that's available to us in the near term. We have moderate levels of debt. Our debt has no contractual amortization left over the next several years. We have currently 63% of our 2017 revenue days fixed, which gives us a high level of visibility, at least for the next year, and a great deal of confidence in terms of looking at how on the capital structure side of the business, how we're going to manage the right-hand side of the balance sheet as we try and build the left-hand side of the balance sheet through the opportunities that we think are going to come to us over the next couple of years. This slide is about me. I've tried most of my life to achieve a high level of anonymity, and apparently I've succeeded because some of the people that responded said that they went and tried to Google me. They couldn't find any information. With the new change of my position, I guess I have to relinquish my goal of perfect anonymity. And so I thought I would just tell you a little bit of story about how I got to where I was, or where I am. I started my career in shipping in Asia in the mid-'80s. There was a shipping crisis at that time. I was working for an American bank, the First National Bank of Boston in Hong Kong. And as a young man, I was thrown about in Indonesia and China and in Malaysia and in Singapore, chasing down ships and trying to figure out how to foreclose and pay the crew and basically assist the bank in recapturing assets that it lent money against and learning how truly complicated the business was. I was a workout specialist for the bank for most of the 80s, mostly in the shipping industry. And I thought I learned a lot about the business. And it was only when I actually left the Bank of Boston in the late 80s and joined the Offer family that I realized how little I knew. I then spent the next almost 17 years working for a company called Tanker Pacific Shipping in Singapore. Tanker Pacific was an operating unit of private company of multiple different businesses, ultimately owned by the Offer family, who, for those of you who have any knowledge of shipping, would understand are a very, very well-respected family in shipping over the last 3 or 4 decades. I spent time in Singapore, first as a commercial director for Tanker Pacific, and then as the senior executive officer there. We built the business from about 15 ships to about 75 ships, all in the international tanker trade, both clean and product. We also initiated a business in the offshore storage sector, which ultimately became a company with about 11 floating storage and offloading vessels that were positioned around the world. We conceived that business and then eventually financed it as a separate business. And that business, both of those businesses still exist today under a different name. I also helped in starting the Offer family's initial investments into the container sector, which ultimately rose to almost 70 ships over the subsequent 10 years. And I was also part of the Offer family international board, basically, which gave me tremendous insight into the other businesses that the Offer family were involved in, including finance and cruise and dry bulk and car carriers, multiple other sectors in the shipping industry. So it was a tremendous school for me to be able to learn from a family, a very tight-knit family of people that had spent all their lives in shipping. And I consider myself extremely fortunate to have had that opportunity. I then left the Offer family in 2005 and ventured out to start my own business, which was called Sea Change Maritime. That was focused on the regional container sector. We raised capital. We ultimately acquired 22 container ships at its peak. We thought we were buying into a down market. We started buying in 2007, 2008. We started to buy in earnest in 2009 and 2010 and 2011. As some of you that follow the container sector may know, that was a value trap because the market kind of fell in 2008 and really hasn't recovered since then. So that was a difficult experience in many respects, but at the same time, I thought one that was valuable in preparing me for this new experience, because the challenge of building a business and then operating it in what was a volatile period, and we're focused on cost efficiency and cash flow generation was imperative in order for us to survive. So I think the other points that I wanted to leave with you is that through the Offer family, I was given an extremely deep grounding in not only the commercial aspects of shipping, but also the technical and the operational side of the business. I was chatting with a gentleman before this session began, and he was sharing with me his experience when he worked at Maritime Overseas some years ago, and he He alluded to the fact that his experience was very broad and very deep because at Maritime Overseas, which is the predecessor company to OSG, he was rotated through every department in the procurement department, in the crewing department, in the chartering, in the agency department. The way that people's careers developed in the old school shipping companies was very much in grounding everyone in the details of the business. So that conversation made me think that was the same kind of experience I had in the offer organization. Great exposure to all elements of the business, and gave me some deep understanding, not only in the commercial aspects, but also the operations side of the business. So I'm also joined and happy to have with us today two new members of our senior management team. Christopher Wolf, who's sitting over here, literally joined on the 1st of December. He's going to be our Chief Financial Officer with Rick Oricchio's stepping down on the 29th of December. Chris will step up and assume that role. I have a tremendous amount of confidence in his ability to do that. He has deep experience in public markets and private markets, and I'm looking forward very much to working with him. Also here today, sitting in the middle of the room, is Susan Allen. She's joined us for about a month now. Also, deep background in public company experience. Neither one of these professionals has a deep background in shipping. But in trying to consider the requirements that OSG has going forward, I thought it very important to emphasize a disparate set of skills in bringing a management team together, so that we can anneal a very strong management team, which brings diversity as well as intelligence, I believe, to build the strength of the management team. So. Both of these managers bring that quality of depth and experience, and I'm looking forward to working with them. I would also like to point out that Patrick O'Halloran and Damon Moat have been with the company for a long time, and so give us that deep foundation in shipping experience. Patrick is an engineer and started his career with ABS and has been with OSG now for almost 15 years. Damon Moat is also a very experienced operations personnel, has been through various aspects of shipbuilding and project planning, engineering, crewing, and he is going to assume the role of dealing with our labor relations and our crew and our human resource deployment across the company, both onshore and at sea. So I think that the slide speaks to itself. We have a tremendously diverse and experienced team of people that will bring their skill sets to the table and do us well in the end. I'd like to point out, philosophically, I believe that management makes a big difference. I think in the public markets of late looking back over the last 10 or 15 years. There has been a tendency to think that shipping can be understood as kind of an asset management business where you can outsource technical, commercial, financial, all of the services can be outsourced, and then the aggregation of these, or the disaggregation of these services, doesn't have an impact on the business. I think that's maybe suitable for a commodity-like business, but as I go through the slides and try and articulate a little bit better, in this marketplace, I think it's not suited, and that's been the position of the company from day one. Management matters. The customers care about the delivery of the product. The operational excellence that we strive to achieve is a differentiating factor, and it makes us a stronger player in this market, and ultimately makes the difference between those that succeed and those that fail. So understanding both the makeup and the principles of the management team for this particular company is something that I ask you to keep in mind, and to challenge us, and to keep in view the things that we do and the promises that we make. If we're able to deliver on those, I believe very strongly that that will be one of the key differentiating factors that makes this business successful. We also have a very diverse and well-respected board. I won't go through the whole list of names here, but the board has been in place since 2014. I myself have been a member of that board since 2014, and so I consider that to be a tremendous advantage for me in stepping into an executive role because I have a well-developed relationship with all the members of the board. I have a tremendous respect for their diversity of knowledge and their integrity in trying to maintain the principles that that have both been set and effectively communicated through the last 2.5 years that I've been involved with the company. The tag at the bottom, which is a nod to Wells Fargo, they do a ranking of corporate governance and try and correlate that with performance of stock. And I think that that echoes the comment that I made earlier that management matters. Their research and analysis demonstrates that high quality corporate governance is reflected in much better performance of stocks over time. And OSG has ranked in the top 10 of that analysis in each of the times that Wells Fargo has tried to carry that analysis out. And I think that that will be a continuing objective of our company is to have that standard of governance differentiate us from other companies and lead to superior performance. So I wanted to try and go a little bit deeper dive into the aspects of our business that we think are important to understand and that set us apart from some of the other businesses. And you know, to some extent, I know some of you are here this morning and maybe getting a little bit of fatigue about listening about shipping, but it's useful for me to use the international shipping model as a counterpoint, not to suggest that one model or the other is better, but just to use it as a comparison to try and to illustrate some of the distinctive qualities of our business and the differentiating factors that creates. We believe that we are a leading we have a leading market position in the Jones Act business. I'll go into a little bit of detail on that. We believe that we have a very, very strong operating franchise, which is trusted by the customer base, and that underpins long-term value because of the need in the context of the Jones Act, the need of our customer base to have reliable suppliers to be able to provide transportation services to them. We believe that the markets that we operate in provide certain competitive advantages that lead us to conclude that that the franchise that we have is more than just the assets that we own, that there is franchise value in the business itself that should be expressed over time in the stock price. And as I alluded to earlier, we believe we start our new life as an independent Jones Act focused business with a very strong balance sheet, one that gives us a lot of flexibility with the liquidity and the debt profile that we have to consider opportunities as we transition through what is currently perceived as an oversupplied market, but one which we think the fundamentals will balance out in the future, and those that thrive through the challenging period of the down cycle will be well positioned to benefit from the long-term prospects of the business. So here's where I get a little bit funky. I'm going to take a glass of water. We have an extremely interesting portfolio of assets and optionality that's built into those assets. And I wanted to try and illustrate that through this slide. This is a strangle option for those of you who went to business school, which I did not. So I've learned it through discussions in articulating the structure of our business with our colleagues in presentation of this. One of the colleagues suggested that what you're talking about is actually a strangle option. The strangle option is an option strategy which you simultaneously buy a put and a call for similar maturity dates. You don't know where the volatility of this industry of the position that you're taking an option is going to be expressed, but you're positioning yourself to have an asymmetrical outcome, an asymmetrically positive outcome in the face of volatility, whether the market moves up or whether the market moves down. The nature of our portfolio, as I will detail in the next couple of slides, gives us that kind of optionality. We have low-cost options in terms of the older rebuilt ATBs that we have in case the market were to change quickly and dramatically. We can hold those options for a period of time going forward that without a significant amount of cost. We have optionality in the tankers that we hold if the market were to collapse. I'm not saying that it would, but if it were, whether, posit a scenario in which that might happen if the Jones Act were, for instance, repealed. That would be catastrophic for the Jones Act industry. But in that circumstance, we have options to be able to redeliver the 9 of the 12 tankers that we have within a very short period of time. And we have optionality that extends beyond that, beyond the initial expiration of those leases that we hold in 2019. In the middle, we have a utility-like return business, which, as I said, should be characterized in the long run by relatively stable long-term contracts. The marketplace for tankers in the United States is driven by the needs of the oil majors and traders to be able to supply their systems in a normalized market, because it's a relatively small market and a niche market, and there is no depth in the spot market that the end users who are naturally short transportation capacity can rely upon in order to service their systems. Then there ought to be a more industrial style shipping characterization to that business than what you would see in the commoditized international market. So in a normalized environment, you've got a very stable long-term contract underpinning to the business. And then when you look at our specific mix of assets and the specific mix of portfolio that we have, we've got optionality to be able to protect ourselves on the downside with an implicit put through the lease structures, lease contracts that we have with AMSC. We have low-cost options in the rebuilt ATBs that we have that we've basically realized the economic value of those. We've written those assets down to levels that don't give us a great deal of financial exposure to the market going forward. And on the flip side, we have all of the benefits of ownership of those assets in the event that the market were to turn. And as I go through this presentation, I'll give suggestions about where those unforeseen elements may express themselves. In this particular slide, we've suggested some of them: the increase of product demand in Florida, expanded Gulf Coast market for transportation of crude, expanded capacity requirements on the West Coast, either because of pipeline outlets or rail outlets going to the West Coast, or through increased crude production in Alaska, or increased population growth on the West Coast that would drive product demand. I believe that if there's one thing that you can take away from this meeting today, it's an understanding of this slide, that trying to sit and analyze what the future spot market rate of the Jones Act market is going to be, or what the time charter rate will be in 2017 or 2018, is a virtually impossible task. You can analyze crude movements, product movements, refinery distribution, what kind of API mix the crude runs are running in the refineries, whether or not European refinery mixes are going to be excess gasoline or shifting to a deficit of gasoline, what the trade flows are, what the WTI Brent spread would be. This is multidimensional calculus that each and every variable can, in and of itself, change the dynamics of how the shipping market works. So trying to predict the future with a degree of certainty and thinking that you can model out the cash flow streams that this business represents, it's an exercise that I think is good to do, and everybody needs to think about it, but it's the wrong way to try and understand this business. To understand this business, the right way to do it is to look at the steady state business and then try and conceive of the options that are embedded in that business. And if you can understand it that way, and you look at the price of the stock and see what's the underlying sort of core business, and if you then conclude that the stock is accurately pricing the underlying core business, which is generally it's an extrapolation of the current market. It's kind of the way the market prices. It just assumes you have a steady state forever. And then you think about, well, how many options do I have embedded in that portfolio? And if you start to tick off the number of options and you realize that you're acquiring a portfolio of options for a very low price, or in fact, for nothing, then that's an interesting financial decision to be making. That's what this graph is trying to illustrate, and we're gonna try and expand on that as we go through the next several slides. This is a depiction of the assets that we actually hold. We have tankers, shuttle tankers, ATBs, lightering ATBs, and then we have two non-Jones Act U.S. flagged vessels that trade in the under the Maritime Security Program, which is a U.S. government program for creating a deeper U.S. flag market outside of the Jones Act. As you can see through this slide, we have overall 26% stake in the market share of the Jones Act by volume. That's spread across the different sectors: tankers, shuttle tankers, ATBs, and lightering ATBs. And then we have the MSP underneath that. Each one of those sectors has its own niche markets that we've been able to establish. The shuttle tankers, we are the only operators of shuttle tankers in the U.S. Gulf of Mexico. We are the only company that has a license to be able to do lightering in the Delaware Bay, and as the next couple of slides will show, that's proven to be a very, very valuable niche market within the Jones Act, which is itself a niche market to be able to operate within. I wanted to touch, because I'm sure that many of you have questions, I wanted to touch quickly on the structure of our leases with AMSC. We have in total 10 vessels that are under long-term leases with AMSC. 9 of them have contracts that expire in December of 2019. One of them is a converted shuttle tanker that has a time charter that runs until 2025. And so that lease has already been extended to be coterminous with that time charter. Each of the leases has options to extend for the remaining economic life, the remaining life of each of the vessels. And the terms of our leases protect us through covenants to give us the right of quiet enjoyment, and therefore we don't need to concern ourselves with possible attempts by either the owners of those vessels or their financiers to interfere with the useful economic life of those assets. So that portfolio of options it gives us a tremendous amount of flexibility. We can extend for 1 year, for 3 years, for 5 years. At each of the expiration dates, we can only use that 1 year extension one time in the life of the assets. But beyond that, you can imagine that given the point in the market that we're exposed to at the time when these leases come up, we have tremendous flexibility to be able to manage our exposure to the market through those lease options. I also wanted to provide a little bit of color on the details of the contracts. We do have a profit share arrangement with the owners of the vessels. The profits are calculated on an aggregate basis across the 10 ships that we have under lease. There is no profit share paid until a credit that was originally granted to us at the beginning of the leases is paid off, as well as funding of dry dock and capital expenditure requirements is met. And neither of those two criteria has been met at this point in time. And we do not expect In fact, at any time during the remaining tenor of the leases that are currently on our books, to be facing the need to make cash payment of profit share to the owners of the vessel. There's a note here that refers to the fact that the credit amount that is outstanding accrues interest at 9.5% per annum. So as time goes by and we're unable to reduce that credit amount, it still continues to accrue interest, giving us a further deferral of a payment of profit splitting as a result of that interest. We have as well, there was a deferred payment that was agreed to in the early stages of the lease. That deferred payment applies to 5 vessels, not to all 10. We were able to defer payment of a certain portion of the bareboat hire to the owners of the vessel over the first several years of the leases to a maximum of $7 million per ship. We availed ourselves of that opportunity, and that deferred payment is now beginning to amortize. It essentially amortizes in a straight line over the next 16 years. And the current value of that deferred payment obligation on our balance sheet is $31 million. And that appears in our balance sheet under other long-term liabilities so that you can understand where that is. The other point that I wanted to try and tackle head on, because I know that it's a question that many have, is we have 8 rebuilt ATBs. Most of these ATBs, the barges and the tugs, which are coupled together as a unit, were originally constructed in the 1970s. All of the barges were reconstructed in 2000, between 2000 and 2006 from memory. The condition of those barges at the time of the reconstruction was certified by the Classification Society, ABS, as being equivalent to their standard Cap 1. For those of you who understand technicalities of the shipping industry, Cap 1 has the equivalent of a new building from a structural point of view. So the physical condition of these assets is, in fact, not to be directly correlated with the original year of built. They have been reconstructed and are much younger than they would appear from their original year of built because of that. We've provided some graphical display of how much of our TCE revenue these rebuilt barges have provided over the last three plus years, and we can see that 41% of that fleet of ATB vessels, their operating days, 41% of those operating days have been covered for 2017. So in the course of the last several months, we've taken decisions about impairment of these assets, and in reducing or accelerating the depreciation of these assets in recognition of the heightened uncertainty as to the ultimate useful life of these vessels. But I would stress that even though we've been conservative in making those impairments in accordance with GAAP and other rules, that doesn't mean that the value of these assets has dropped to zero. There's still considerable cash flow potential left in these assets. The condition of the assets is not, as I said, is not correlated with the year of original year built. We have a high level of confidence that the standards of maintenance and the structural integrity of these assets is still very, very high. What's giving us cause to believe that there's a heightened uncertainty in the ability to continue to trade these assets is not the physical condition, it's the acceptability of these assets in the market. In order to trade petroleum products or crude, the market users, the customers, have vetting requirements. Many of them have vetting requirements that look to one factor being the age of the vessel as to the acceptability of those assets. That's been the case for many years now in the tanker industry. What's changing is as the standards tighten, the availability of younger tankers or younger assets to be able to transport crude and product makes it easier for the end users to tighten their standards to be able to choose younger vessels over older vessels. I think for many of the oil companies, this is a public relations problem more than it is a concern about the actual physical capability of the ships. It goes without saying that if there were to be an incident on an older vessel, that the public relations focus would be very much on the age of the vessel as opposed to maybe the other factors that maybe had caused that incident. And our customer base is very concerned about that, and therefore they some of them put restrictions of age in terms of ships that are acceptable within their system. I think it's important to understand that vetting doesn't only apply to charterers of the ships, but that it also applies to owners of terminals at which ships would like to call in order to move product. How that works in terms of the demand for our rebuilt ATBs is that, as an example, BP has a 20-year age restriction on assets that they would find acceptable under their vetting system. But there are other users of our assets, traders or others that maybe are less concerned about the public relations issue of using older assets and are more focused on the economic benefits that those lower priced assets can provide. But if a trader, let's say, wants to take a rebuilt ATB on charter and then wants to call at a terminal which is owned or controlled by BP, then that 20-year age restriction still applies. And so as the terminal control is subsumed within the vetting qualifications, then the traders become more and more reluctant to try and take these ships to trade them, because if they're going to buy a cargo at one terminal or another, they're not going to know on a day-to-day basis whether or not the cargo that their trader is buying is going to be at a BP or a Chevron or a Motiva terminal, which because of the terminal vetting restrictions would prevent them from going and actually using that asset to move that cargo. So I think that's a subtlety that it's not often understood by people. It's not just the charterer's requirements, it's the terminal's requirements that is creating this vice of narrowing opportunities for us to use these assets. I'd like to, again, on the thematic note of optionality, given the structural integrity of the assets and our belief that they still do have physically an extended operating life remaining in them, there is an ability to consider and explore adjacent opportunities to repurpose these assets into some other use. The fact that we've significantly reduced the carrying value of these assets gives us flexibility in looking at those potential adjacent opportunities. And if we were able to actually find and execute on some of those opportunities, then it would free up potentially the optionality embedded in another 5, 10, or 15 years of operating life that you could generate through that adjacent opportunity. So I wanted to give a little bit of a flavor for the breakout of how Jones Act vessels are deployed in the market. This looks at a number of distinct markets, the main ones being West Coast United States, Gulf Coast, clean transportation, and crude oil. The Gulf Coast clean transportation market is 45% of the market and is by far and away the largest and most stable of the markets. OSG is operating in that market with about 29% of the capacity measured in barrels. So that's kind of the core market, has been traditionally known in the Jones Act as the main Jones Act market. The other section, the crude oil section, that's a newcomer to the market, and in many ways That's the swing market today in terms of understanding supply and demand dynamics. Virtually 5 years ago, virtually no tankers at all were involved in crude transportation. With the advent of shale oil and the rapid increase in production of crude oil in the United States, and given the economics of short-term transportation of that crude oil to refining centers in particularly in the Gulf of Mexico, that created an unforeseen at the time, but now very real demand for additional transportation, and triggered a very large increase in building to try and satisfy that demand. As we'll show later on in some of the slides, price of crude changed, went down. That had an impact on the production of crude in the United States. The production of shale oil peaked and has fallen close to 1 million barrels per day from its peak. And that's resulted in a significant drop in demand for transportation of that shale oil to the refining centers in the Gulf of Mexico and on the East Coast. And that's given rise to what is now considered to be an excess of supply in the market that needs to be worked through. The question from my view in looking at the optionality that's embedded in our portfolio is understanding that the crude market right now is the primary swing, the swing market for demand. What's going to happen to U.S. crude production? Some discipline expressed by OPEC in trying to reduce production and pushing prices up and stimulating production in the United States. That would theoretically be very positive for our business. Any geopolitical disruption that would impact either the supply or the price of crude could once again stimulate significant increase of crude production and crude transportation needs in the United States. Figuring out that calculus is difficult, but I think that the recent history of the market is a good example of an expression of optionality. There was no crude transportation 5 years ago. That boomed to almost 35 ships at one point because of the rise of crude production in the United States. That's fallen off to probably half that capacity today. But latent within that market is the potential for those dynamics to change once again, given the factors that influence crude pricing and crude production. I wanted to highlight another one of our niche within niche businesses. This is the lightering business that we operate out of Delaware Bay. Simply stated, we have two purpose-built vessels that are the exclusive assets for lightering vessels that bring crude oil from international waters to service the Delaware Bay refining customers. Because of the depth of the bay, the bigger ships that are being utilized for transportation to gain economies of scale from longer distances, transporting that crude from longer distances, they can't get into the refineries themselves, and so technically there needs to be an offloading of cargo in order to lighten the vessels to a shallower draft to allow them ultimately to discharge the balance of the cargo alongside the terminal quays. This lightering process is done by us as the sole licensee for doing those services in the Delaware Bay, and the contracts that we have with three of the refineries in Delaware Bay have provided for us an interesting hedge to the decline in production in the Gulf of Mexico. If you go back and you see what these charts are pointing out, lightering volumes dropped off significantly from 2013 to 2014, and then started to recover again in 2015. If you look at the parallel production volumes in the Gulf of Mexico of crude oil, you will have seen that that correlates very, very closely with when crude production levels peaked or inversely correlates with when crude oil production peaked in the Gulf of Mexico. There's another factor that is at play here, which was the WTI Brent spread was very wide during the period of 2013 and 2014. which created an incentive for the Delaware Bay refineries to be bringing crude oil from the Gulf of Mexico rather than from international, because of the deep discount that WTI was priced to the crude. So the trajectory in 2013, 2014 was negative for our lightering business. As the price of crude dropped, most importantly, in my view, the spread between WTI and Brent collapsed. Then the economics for importing crude for the East Coast refineries reasserted itself. And then we saw volumes begin to pick up again. And as the volumes picked up, since we're the only ones that are able to lighter those volumes, then the volume of our lightering business picked up significantly. And if you look at our Q3 2016 volumes as compared to Q3 2015 volumes, as an example, those volumes were increased by roughly 32%, which was a significant move and helped stabilize our cash flows that were otherwise being negatively impacted because of the weakening conditions in the Gulf of Mexico. We have two other niches that I wanted to touch on here. One is the shuttle tanker business that I alluded to earlier. Shuttle tankers are the most cost-effective way for moving crude oil from offshore production facilities in the Gulf of Mexico to the refining centers in Texas and Louisiana. These contracts tend to be long-term in nature because of the speciality of the assets. The tankers themselves need to be converted to be able to cost-effectively take crude from the offshore FPSOs or platforms, and then to deliver them to the refining centers in Texas and Louisiana. We've made those investments in 3 of our tankers, 2 of which are owned outright by OSG. One of which is, as I said earlier, on a one of the long-term leases that we have with AMSC, which extends through 2025. These assets provide a level of stability in our cash flow going forward, and also give us an extremely interesting option into any expanding production in the Gulf of Mexico. It's very, if you look at the shuttle tanker business in the North Sea, for instance, the way that it evolved in the early period, there were long-term charters that were entered into by the providers of those shuttle tankers. But as the market evolved and more production came on stream, the nature of doing the business shifted to a contract of affreightment. And in order to have a contract of affreightment, you need to have a minimum scale in order to be able to do that business. If one thinks that the Gulf of Mexico could develop in a similar way to the North Sea's development, then we're in a unique position to be able to start to consider servicing customers with a contract of affreightment model rather than time charter model. And at this juncture, nobody else would be able to compete in that way because we're the only ones that have that capacity, and so the only ones that would be able to even conceive of a contract of affreightment structure. So this is an interesting long-term play in the market. Whether you think Gulf of Mexico crude production is going to increase or not over time, that's a discussion that reasonable people can have. But if you consider that it will increase over time, and the deeper that production goes into the Gulf of Mexico, the more dependent it will be on shuttle tanker capacity to be able to service that. I think that lays a very interesting long-term potential for us in this business. The other point that I wanted to point out is we have 2 vessels that are not Jones Act vessels. They're U.S. flag vessels. They're not permitted to trade coastwise in the United States, but they do trade within the Maritime Security Program. The Maritime Security Program consists of 60 vessels that receive support from the U.S. government in order to maintain U.S. crews and the U.S. flag in case, in the time of distress, the Transportation Department or the military, the Defense Department want to draw on U.S. flag assets where the crews are considered to be loyal. This gives them a quick outlet to do that. Congress has approved a recent increase in the fees that are paid in order to participate in that we benefit from by participating in the Maritime Security Program. Those fees have been increased from $3.5 million a year to $5 million a year, and so that that should once the allocation of those funds that have been or the appropriation of those funds that have been approved by Congress are cleared through the legislative process, then that will be an increase for us in cash flow. We also take those assets because of certain benefits that the U.S. flag provide. We're able to work preference cargoes. The most notable of that is the Military Sealift Command. Military Sealift Command, when they have a requirement in the market, they must first seek U.S. flag vessels in order to satisfy that requirement. That gives us a leg up in being able to utilize these assets as well as some of our Jones Act ships in servicing those requirements. And over time, that has tended to pay premiums to the international spot market because of the benefits of the preferences that are given to us. So we trade those ships from time to time in the spot market for the Military Sealift Command. We also have the benefit of a long-term contract of affreightment with the government of Israel. That contract has been held by OSG for many years. It utilizes about 1.5 ships a year in order to service that contract, which is at a fixed, stable rate. And the nature of the contract of affreightment gives us a lot of flexibility as to how we use those ships in trying to service that, giving us the ability to play the spot market with these two ships for cargoes such as the MSC cargoes. So over time, although these ships are kind of notionally trading in the international market, they're able to earn substantial premiums over what international product tankers are because of the benefit of this contract and the benefit of the preference cargoes that we're able to avail ourselves of. I wanted to touch a little bit about the basic dynamics of the markets, the geographical markets that we operate in. To understand the Gulf of Mexico clean product market, the easiest way to do that is to understand that Florida is an island. Florida is unique in the United States, at least east of the Mississippi, as a state that is not served by pipeline, nor does it have any refineries. And so all of the transportation fuel that comes into Florida, and remember, Florida's like a country. It's 20 million people. It's growing. It's a very substantial part, a very substantial market. Represents about 8% of the total clean product consumption in the United States. All of that is served by sea. It's served by sea domestically through the Jones Act trade, as well as through international tankers that can also load cargo internationally and bring them into Florida. The chart on the right-hand side of this slide is an effort to try and illustrate the stability of this market. It is a slowly growing market. It's a little bit seasonal because of the Florida vacation period in the February to April period. And over the last several years, that seasonality has been served by international tankers. Part of that has been because the Jones Act market was constrained. I think there are analyst views that as we look forward, some of that seasonality will now be picked up by the Jones Act market if there's surplus capacity that's available. So there is a very stable market there. As I said earlier, we have about 29% of the market share of that market, and that's the clearest understanding of what has traditionally been the Jones Act market over the years. Looking up the East Coast, there is a market for delivering Gulf Coast refined product up into the East Coast as well. That's predominantly served by the Colonial and Plantation pipelines. Those pipelines are running at or near capacity at the moment. So as we look forward, and depending on your view as to how much gasoline, jet fuel, and diesel fuel consumption will increase in the United States, that does open up opportunities to be able to consider a growth in demand from the Gulf Coast to the East Coast, or from the Houston and Louisiana refining centers up into further up the East Coast of the United States. We're well positioned to serve these markets. We have ATBs that have served our customers that are active in these markets for many years. We also have some of our tankers operating here, and this is a good reason why we're based in Tampa. If you look at this slide, it gives you some of the takeaways of the market attributes and the market position for crude transportation. The graphic on the left-hand side is giving you an indication of where crude moves out of Corpus Christi into the demand centers, Texas, Louisiana, some up into Canada, some up into the Delaware Bay refineries. The graphic on the right-hand side gives you a very clear picture of what happened. The Eagleford crude, which is predominantly being exported out of Corpus Christi, as the production boomed in over the last 2 or 3 years, it peaked at almost 800,000 barrels per day of export out of Corpus Christi. That coincided with the surge in demand for crude transportation. As you can see from that graph, it's fallen off very sharply as a result of the decline in oil price, and as production of the Eagleford Shale has dropped off. I've provided, and we'll give you another graphic on that in another couple of slides, just to get a sense of again, the optionality that's built in and how the sensitivities of demand can change very quickly given the relatively small nature of the business. If crude oil production were to increase back to levels that it was a couple of years ago, depending on where that crude oil were to go, assuming that it was to be consumed within the United States, if it were to go to Houston, that would consume about 3 to 4 tankers of additional capacity. If it were to go up the Mississippi, that's about 7. If it were to go to the Loop, the Louisiana Offshore Oil Production Center, that would be about 5 tankers. And if it was to go up to Delaware, that would be about 14 tankers incremental demand. Now remember that the total market in this sector is about 100 ships. And so when you're talking 2, 3, 4, 5 ships of incremental demand, it doesn't sound like a lot in nominal terms, but in real terms, those are significant percentages. And those tipping points in supply and demand can change very quickly and affect the rates of return that we can earn on our ships. I wanted to point out that we're also active in the West Coast of the United States. We're servicing not only West Coast refineries and the distribution patterns that exist on the West Coast, but we also have a unique position in Alaska through tankers that we operate in and out of Alaska, both in the clean and the dirty trade, as well as through a joint venture participation that we have together with Keystone and BP in Alaska Tanker Corporation, which is running crude oil from Valdez down to Washington and California for refining. Operating in this geographical area is very different than operating in the Gulf of Mexico. The environmental and regulatory standards are much higher. The demands of the customer are much higher, and the barriers to entry through those demands leave very few participants the ability to serve this market. OSG has been active in Alaska and the West Coast for several decades, and that established position is one that we think gives us an interesting angle into potential changes on the West Coast. And again, on the theme of optionality and looking at what it might do, the two things come to mind. You have discussion about Tesoro and Savage building a new terminal, a rail terminal to take North Dakotan shale oil out through Washington. That the capacity of that terminal would be 360,000 barrels per day. If you then needed to distribute that crude oil down to the refineries in the United States, if you were to assume that it was to go to San Francisco, which is where most of the refineries are, that would be an incremental 6 or 7 tankers to be able to just to move that crude. So there's quite a bit of controversy about whether or not that terminal will be approved. Changes in the political environment might suggest that maybe resistance in the past would be dissipated somewhat. But it could happen, and if it were to happen, that would change the dynamics of West Coast transportation almost overnight and create additional capacity demand there that would materially, in my view, materially change the pricing dynamics of the West Coast. This is a graphic that we put together, and it's just an illustrative one, and trying to give you, again, an insight into what would happen if production in the Gulf of Mexico coming out of Corpus Christi were to be increased by 350,000 barrels per day, and making the point that I made earlier that in transporting that crude oil, the round voyage to Houston is 3.5 days, up the Mississippi 7, to the Loop is 5 days, and to Delaware it's 14 days, and you can do the math and figure out how many incremental ships that would require, given a 350,000 barrel assumed capacity of each of those ships. It's interesting, I was doing some reading earlier today that these are the kind of perfect transit times. Of course, you don't always have perfect transit times. You have delays, you have terminal restrictions, you have weather, you have other things. So David St. Ammons in his research determined that the average utilization factor for ships trading in the Gulf of Mexico and the U.S. Flag Jones Act market is around an average of about 14 days voyage. So there's obviously some voyages are shorter, some are longer, and there's obviously some delays in getting to that number. But the point is, if you get a 350,000 barrel per day increase in production, it can have a quite a swift and dramatic impact on demand for Jones Act vessels operating to serve those markets. The other point I wanted to bring into this is just to highlight the fact that the East Coast of the United States, as I said earlier, is predominantly served by the Colonial and Plantation pipelines. As many of you will recall, there were disruptions in those pipelines recently, twice actually within the last 3 or 4 months. One was a leakage of the pipeline, the other was an explosion. In each case, the pipelines were shut down for a period of time. They were reactivated quite quickly in relative terms, but what those shutdowns did was to highlight the vulnerability of the East Coast to those pipelines, and the fact that once those pipelines are either full or not able to operate, that the only cost-effective way to move Gulf Coast product into the East Coast of the United States is on Jones Act ships. I can tell you that we had one open barge when the last incidents of the Colonial Pipeline occurred. We had one open barge where notionally the charter rate for that vessel was maybe in the low 20s on the broker assessed basis. Because of the pipeline outage and the shift in demand that was immediately created, we were able to fix that ship for nearly twice what the assessed rate had been the day before. So the sensitivity there is extremely high. And I think as well that the point is that the Delaware Bay refining network that we serve through our lightering business, many people consider that those refineries are dated and uneconomical. But the vulnerability of that pipeline, to me, is going to suggest that the death of those refineries, which has been often predicted, is probably going to be a long way away, because those refineries, once the pipeline was shut down, were really the only close-in capacity to serve with gasoline, diesel, and jet fuel markets at that time. So I think it's an interesting fact that a lot of people aren't fully aware of, is the reliance that all of the population centers along the East Coast of the United States have on these pipelines, and the opportunity that can be triggered when there are disruptions of that pipeline for our tanker business. The other thing that I wanted to point out is, according to most analysts, the pipelines are running full. Depending on your view as to product consumption going forward, if the East Coast of the United States were to continue to increase its consumption of transportation fuels, then those pipelines would not be able to service them absent an increase in their capacity. No doubt those markets could be served by international markets, but the dynamics of the international markets also come into play here. For the last many decades, Europe has run a surplus of gasoline because of its choice to be able to favor diesel fuels over gasoline. That trend is, according to many analysts, in reverse. And so the traditional surplus trade of gasoline moving out of Europe into the United States is potentially drying up. And if that's the case, then the surplus of gasoline will come from somewhere else, and it could well come from the Gulf of Mexico. And that would create demand for the Jones Act vessels to be able to deliver gasoline and other transportation fuels up into the East Coast of the United States. And I remind you from the previous slide that if you take the voyage days to the mid-Atlantic states, that's about a 14-day voyage and significant incremental demand. This slide is just to reinforce the concept that we have a very strong track record with the familiar names that you see here as the major players in the U.S. Distribution of product business. We feel that reputation has been well earned and gives us a significant position to be able to protect our market going forward because of the constraints that exist for others to enter the market. A question that I asked myself when I was kind of prepared for this session was, what is the best way to define the Jones Act shipping business? Is it really a shipping business? Is it an industrial shipping business? Is it an industrial business, or is it a midstream business? And in many ways, the characteristics of our business are in a normal state much more akin to a midstream business than they are to for instance, the international tanker business. The characteristics of that are, as I said, are long-term stable cash flows that are defined by deeply entrenched relationships with the end users. I think that the volatility of the optionality extends outside of that long-term structure, and in a normalized market, the end users' dependence upon the supply and the lack of readily available spot capacity should lead to that kind of structured and long-term relationship. The other elements of the market that assist us in thinking of this really as a supply system as opposed to a commodity that's subject to the vagaries of the market. As we know, there's limited foreign access. Most of the shipping expertise around the world is outside of the United States. None of those companies can participate directly in the Jones Act, and that limits the players that are able to do that. The regulatory environment that is driven by the likes of Open 90 and other types of regulations that are stricter here in the United States create levels of discomfort for foreign players that might otherwise think that they could be interested here. The customer requirements provide for very strong barriers to anyone trying to start up a tanker business. You can't get your ships employed by the oil companies unless you have vetting approvals. The oil companies generally don't want to vet companies unless they have a need for their system for those assets. And they don't have a need for this system. If you don't have assets already to give to those people, then they don't have a need. So there's a catch-22 there that benefits the incumbents in a big way. Also in the way that the crews are deployed, and the oil companies have a matrix system that demands that you have a certain level of experience of your crew on these assets over a period of time in order for them to be qualified to operate within their systems. There are also economic barriers. The long-term nature of the contracts to go and build new capacity. The current perceived oversupply in the market is limiting the ability to put further long-term contracts in place. Also, there's only a limited number of shipyards that can build. Jones Act obviously has to be built in the United States, a Jones Act vessel. So there's only 2 shipyards that need to be that are capable of building tankers at this juncture, for instance, and those yards are filled until the end of 2018. So even if you wanted to be a new entrant into this market, it would be very difficult for you to get any traction. So the market is quite protected in many ways, and being able to sustain a position in that market, to take advantage of changes in the market and the opportunities that we think are coming up, is fundamental to the strategy that we have for ourselves. I wanted, before turning it over to Rick, to take you through some of the financial elements of our business, to highlight that our balance sheet and liquidity provide us with tremendous flexibility. We have total cash in excess of $200 million. We have debt, combined debt of just under $550 million. We have no scheduled amortization on that debt for some time. And we also have an undrawn revolver of $75 million that gives us access to further liquidity if the opportunities were to present themselves to use that money. So with that, I'm going to turn it over to Rick to take us through some of the financial details before coming back to leave you with a few thoughts.
Thanks, Sam. I'm just going to experiment here to see which way this goes. Wrong way. I had a 50-50 chance and I chose the wrong one. Perfect. Okay, so I'm just going to spend a few minutes and going through some of the financial metrics of OSG. But first I want to start, I've had the pleasure of being the OSG CFO for the past 2 years under Ian's leadership and the other senior managers. And as Sam noted earlier, I'm going to be leaving the company at the end of the month. And we are very fortunate to have Chris Wolf, who started last week, join the firm and will be assuming the role of the OSG CFO. Chris is a very experienced CFO. And as a result, I think that he is the perfect candidate to bring this organization through this time period and into its next level. Okay. A few comments, and Sam touched upon these briefly. As you can see from the slide, as of September 30th, we had $209 million worth of cash on the balance sheet, total debt of $542, including $82 million of holdco bonds, resulting in net debt of $333 million. As outlined in the 8K we filed yesterday, we have $244 million of equity, resulting in a net debt to equity ratio of 1.4 times. Total available liquidity is $284 million, including 75 of that undrawn revolver capacity. I'm now going to move to page 30 and spend a couple of minutes talking about the actual components of the debt side of our balance sheet. The bonds that are up here are at the holdco level. There's $82 million of the bonds that are due in March of 2018. As part of the company's reorganization in August of 2014, a very small number of those bonds are actually due post-2020. There's a $75 million revolver at the operating company, none of which is outstanding. The status of the bonds at 12/29/17 will have an impact on our ability to utilize the revolver in the future. Management's still deciding how we're going to approach those bonds, but it might have an impact on the revolver. Finally, we have $474 million of term loan that is due in August of 2019. At this point, there's no further scheduled amortization that's required on that term loan because of the early payments that we have made on those loans. We have already prepaid $40 million of the expected 2016 cash sweep on those loans. As a result of our 2016 operations, we anticipate another $19 million of cash sweep payment to be due in March of 2017. Our expected performance for all of 2016 indicates that we should have approximately $59 million of available amount under the terms of our term loan that will be available to us in March of 2017. That will provide an enormous amount of flexibility to the company as it approaches the various opportunities that Sam was describing earlier. I'm going to turn to page 31. A little graph describing the niche businesses that we have. As you can see, TCE revenues for the period, the last 12 months ending September 30, 2016, were $451 million. There's a reconciliation between TCE revenue, which is a non-GAAP measure, and shipping revenue, a GAAP measure, in the appendix, so that you could walk between the reported financials and TCE revenue. This slide does highlight, though, the niche businesses that Sam was describing to give you a sense of the relative size. I'm going to turn to page 32. As you can see from the table in the upper left, TCE revenue per day was approximately $52,000 per day for the last 12 months ended 9/30/16. Our fleet has been stable at the 24 vessels. You'll also see that our revenue days increased in the last 12 months compared to prior periods, and that happened because we accelerated a number of dry docks into 15 in order to defer the decision on whether or not we are going to install ballast water treatment systems on a variety of vessels. So it provided us, once again, more flexibility, and it supports the optionality that Sam was alluding to earlier. The table on the upper right shows the level of our adjusted EBITDA for the noted periods. It's a metric we use to think about the business on a daily basis. There's a reconciliation between adjusted EBITDA, another non-GAAP measure, and net income, a GAAP measure, in the appendix. Brief comment on the tax highlights. I think it's important to note that as a result of the separation of OSG and INSW, a couple of things happened. One, we eliminated a potential tax liability of $125 million that was hanging over OSG in the past. In addition, OSG now has unfettered access to an NOL carryover of $396 million as of 12/31/15 that's fully available to offset now just its taxable income instead of potentially some of INSW as well as OSG's taxable income. Brief comment on G&A on page 33. What we wanted to do here was just provide a high-level bridge covering our G&A. Obviously, we're very focused on this right now. We're starting a new chapter in the OSG story, and this gives us an opportunity to think about what we spend, how we spend it, and why we spend it. There's certain structural, non-recurring costs that are embedded in the $34 million that is disclosed in the 9-month amounts highlighted in the Form 8K. That's where the 34 comes from. You filed an 8K yesterday dealing with the 9 months up through the separation, for the 9 months ended 9/30. And that 34 is really the starting point that I thought would be appropriate. So I'm going to pull you back to that 8K. The bridge also recognizes that in addition to those non-recurring costs, there are certain additional structural costs that were previously housed in New York that will not be part of the OSG platform on a go-forward basis. For example, certain accounting and reporting functions that were performed in New York and had their costs allocated between New York and INSW are now going to be performed by current OSG staff in Tampa. And as a result, there would be a net reduction in the spend to accomplish those tasks. Other functions that were previously performed in New York are also being absorbed within the existing OSG staff in Tampa. So management recognizes that spending discipline is important to preserve our options, and as noted in Sam's bio, and when he was doing his slide, he kind of he went through that part of it fairly quickly, but a significant portion of his history is dealing with understanding and executing efficient cost structures. So he brings that talent and that experience into this new role. Sam has already been, and all of us have already been at work at reducing the G&A footprint for the rest of 16 and into the future. And we have taken and continue to take concrete steps to achieve safe, reliable operations while ensuring our costs are tightly controlled. These steps aren't easy, but we're going through them, and we have taken some, and there are others that we will take shortly. So that's all the prepared remarks I'm going to have from a financial perspective. Thank you for your attention, and I'll turn it back over to Sam for our closing comments, and then we'll get to some Q&A.
Thank you, Rick. So I'm going to bring you back to this depiction to refresh everyone's memory or mind, and maybe get you thinking again about what is it that defines our business? What is it that distinguishes our business from other shipping businesses that you may be familiar with, or from other U.S. companies that are involved in the transportation business? And the graphical picture here, to me, is a very good image to carry around with you to remind yourself that we have niche businesses that generate stable and visible cash flows, that establish a platform for us to be able to benefit from the optionality that the U.S. market presents. Optionality in the form of Rumsfeldian outcomes. And for those of you who don't remember Donald Rumsfeld, he was famously quoted as saying, well, you have your knowns and your unknowns, and you have your known unknowns and your unknown unknowns. So as you drift further to the left and the right of this graph, you're getting deeper into the unknown unknowns. And I think that's a very interesting position to be in, and to be able to take advantage of given the fundamental platform that we have. And we've tried to articulate here some of the known unknowns. Global supply and demand, the dynamics of the politics there, how that expands, how oil is consumed or moved across markets, supply chain disruptions, whether because of inbuilt infrastructure constraints or because of disruptions caused by unforeseen disruptions through explosions or outages or other things that we've seen recently. Vessel supply, how regulatory elements and capacity, how economic decisions that we and our competitors will take in terms of how we deploy those assets, and the other factors that will come into determining the economic life of those assets. There are a lot of unknowns there. And of course, the political environment that we operate in. I was reading the Bloomberg news today talking about they have an annual feature about the ultimate pessimist. And one of the scenarios that they were trying to paint out was that Saudi Arabia has a difficult time in the near term. The political unrest there results in disruption of supply from Saudi Arabia, and that changes the petropolitics overnight. So how do we take this platform, and how do we conceive of a way to grow our business in what is admittedly a niche business? This is something that has consumed a considerable amount of my time in trying to think about how to go about injecting a a promising future into this platform without really understanding how that optionality may express itself, but being awake to that every day and making sure that we have the capacity to take advantage of that optionality when we see it. I see there's really three principal challenges that we have as an organization to being able to drive a meaningful growth story through this platform. One is, how do we deal with the current excess supply that exists in the marketplace? We ourselves have 8 rebuilt ATBs that probably represent a considerable portion of the marginal capacity that exists in the market. How do we manage that position to the best of outcome for us as a company, as opposed to the outcome for the market? And how do we think laterally about ways that we can potentially remove that capacity from the petroleum transportation element and redeploy those assets into other uses that will allow us to free up and recognize cash flow capability of those assets given the quality of their physical condition as they are today. I think there's a second element in addition to the capacity, which is scale. The ship, we really are in aggregate 2 businesses. We're a ship management business and we're an asset ownership business. The ship management business, in order to achieve the efficiencies necessary to drive the operational leverage of the business in a meaningful way, needs to attain scale. How you do that in a marketplace that's only got 100 ships? Clearly, there are opportunities to consolidate some of the smaller players in the market, and that's something that we think that the challenging short-term conditions in the revenue market could throw up opportunities for us to pursue those kinds of consolidation opportunities. But I think we also need to be thinking laterally to adjacent areas where we can take the specific and differentiating skill sets that are necessary to achieve the management position that we have in the tanker industry. Can we apply that to other adjacent markets where assets can be managed efficiently, and to be able to then put scale through that management company to allow it to achieve much better returns? I mean, just to highlight the point, the ship management business, whether you run 1 ship or 50 ships, you need a safety department, you need a technical department, you need an accounting department, you need all of these service departments to be able to make that work. But the incremental addition of assets under management don't require you to add another accounting department, don't require you to add another technical safety and quality department. So an ability to find assets to increase assets under management can drive the cost efficiencies of that management business very, very quickly. So how do we achieve scale? How do we think about what is it, the core skills that we have as a management company, and how do we apply those skills to adjacent asset spaces is something that's going to be in the forefront of our thinking as we go forward. In terms of some of the optionality that I've tried to explain through the course of this presentation, we think that there's interesting optionality on the West Coast, and we want to look for ways that we can expand our presence on the West Coast of the United States and into Alaska. If crude oil were to increase, production were to increase in Alaska, we want to be there to make sure that we play a meaningful role as we have historically. If certain outlets of North Dakotan or Canadian crude were to flow out to the United States and need to be distributed along the West Coast, we want to be there and be able to take advantage of our position, both physically, but also because of our reputation and our ability to satisfy the regulatory and environmental concerns of those states in particular. As I mentioned, we want to explore the operational skills, exploit the operational skills that we have in order to look at adjacent assets. I just spent the last 10 years of my life in the container sector. There are other assets in the U.S. flag, not necessarily the Jones Act, whether they be container ships or car carriers or heavy lift vessels. There are other assets in the MSP program Maybe we're looking at smaller assets, maybe slightly different types of assets. We need to expand our understanding of what our markets actually are, and think about how to apply the skill sets that we have and to be able to increase the assets under management. And then finally, I think we need, as I said, in particular with respect to our barges, we need to explore redeployment and repurposing opportunities. And if we're successful in that, there's a tremendous amount of upside potential that exists, which is not being valued at all in those assets, and which could potentially give us a whole new outlet for utilizing those assets in the long term. I think those are all really interesting and very exciting opportunities. There's an ability for us to discuss those in broad terms. I think you can appreciate that we have a little bit of more difficulty to discussing them at this juncture in very specific terms. But I challenge all of you who are interested in this business to take advantage of sorry, gotta go backwards. Take advantage of this visual image and trying to understand how we go about thinking about the opportunities in our business on a day-to-day basis, and how we position ourselves for changing market environments with this particular playbook in hand to meet the challenges the three challenges that I've articulated. So with that, I think it took a little longer than maybe what we wanted to, but we still have time for questions for those that want to open them up. We'll take questions.
We have a question back here.
Hi, thanks. Quick question for you.
Sorry, just to be clear, could you state your name and who you represent?
Sure thing. Ishur Sani from Citadel. Two quick questions. One is, what is your break even, your operating break even, your cash break even at the ATB level? And then the second is, how do you view capital allocation or capital return to shareholders over time?
Let me take the second question first, because I think that's a little bit easier for us to address. Certainly my view at this time is that the opportunities in the domestic business, at least as I see them, suggest that we will be reinvesting capital into expanding and fortifying our franchise, and that that's the best use of capital that is likely to present itself over the foreseeable future. Obviously, if circumstances were to change, we would need to reevaluate that on periodically. But if you're looking for guidance as to the predisposition of management and the board, I think that the separation of the international and the domestic business has created an opportunity to expand the platform because of the reasons that I've suggested earlier in the presentation, and that capital in the business and generated by the business will be well spent in pursuing that objective. On the ATBs, break-even levels are a little bit difficult to try and pin down. Each of the assets is unique in many ways. Our lightering business is different from some of the barges that are operating in the Gulf of Mexico. Some of the assets have, because of their nature, they have more crew members. Some have less. Some have, they have different engines. So for instance, their lube oil consumption would be either more or less. And so each asset is relatively unique. And therefore trying to give you one number to hang your hat on is a little bit dangerous in terms of providing guidance. So I think that we do break out the TCEs of the individual vessels. I think that there are available guidelines through comparable companies or through analysts that have tried to unpack some of the publicly disclosed information. You can use those as guidelines in terms of how you think the numbers should work, but with the caveat that on a portfolio, those guidelines are probably right. But if you're trying to pin it on a vessel by vessel basis, that the variation between the vessels can in fact be quite high.
Got it. And just to follow up, what is your ideal leverage target and or LTV?
That's a relative question as well. The way I would answer that question is the longer your cover of visible cash flow in the future, the greater the ability for you to leverage that appropriately given the visibility of that cash flow. The shorter your cover, the more liquid you need to be in order not to be in a position where you get a margin call, because the optionality of that asset portfolio is valuable only to the extent that you don't have an expiry date. So the right capital management strategy needs to take into consideration not only the nominal level of leverage, but the amount of cash that you have on the balance sheet and the forward cash flow cover that you have in order to service that debt.
Got it. Thank you.
Yes, sir. Sorry, I don't mean to be difficult, but I've been asked to ask you to state your name and who you represent. There is a webcast and people can't
Bruce
see
Berger with Contrarian. How many ATBs and tankers are under contract right now, and what's rolling off for the next 1 to 2 years? And also, what's happened to the spot rate in the ATB market over the last 2 years as this excess capacity has started to develop?
So the universe of assets that are considered in this business has been defined by an industry analyst, a company called Navigistics, David St. Amans, and he defines the universe as tankers and articulated tug barges in excess of 140,000 barrels. Now, there are assets below that, and there are ways that you could expand that definition. So I caution, I make that caveat in terms of saying that traditionally the way that our market is defined is through those parameters. So if you take and you agree with that parameter, there are today, after recent new building deliveries, about 91 vessels in total. And the split there is roughly 47 ATBs, and the balance are tankers. There's an additional 9 vessels that are on order, 5 tankers and 4 ATBs, so that the universe of vessels, including those yet to be delivered, is roughly 100 ships. 100 ships. Did I answer the rest of the question?
Well, what's your risk? How many ships are on charter now that are coming off?
Of our ships?
Yeah.
Well, we've given the indication that earlier that we have 63%. What was the number? 2017. Right. 41% of the available days of the ATBs have contracted coverage for 2017. For the entire fleet, that number is 63% of available days for 2017. I would note that.
The fleet that Sam is mentioning is ours.
Yes, 63 of our fleet. I would note that included in there are assumptions that we make about the lightering business activity through the contract cover that we have there. Those are contracts of affreightment. We also have a contract of affreightment on the 2 MSP vessels that cover, as I said earlier, about 1.5 ships. But those are reasonable assumptions to be making given the nature of the contract. So we equate those as being the equivalent of covered days.
We have another question.
Hi, Donald Bogdan with Wells Fargo, and thank you for taking my question. Can you talk a bit to the upcoming dry docking schedule on the ATB fleet, if that's loaded in 2017, 2018, or 2019, and how we should think about your sort of approach to whether to rationalize some of that tonnage or invest in it and keep it in operation?
To my knowledge, the ATBs start to face dry docking capital expenditure thresholds in 2018 and 2019. The drivers to whether or not we would take vessels through those dry docks are multiple, with effect from the first dry dock after September of 2017. All of the vessels that are operating between regions in the United States or operating internationally will need to comply with ballast water treatment regulations. The ballast water treatment regulations operating in the United States demand that you install a system that will not only neuter but will kill any bacteria or organic life that could be transported in the ballast water from one region to another. The cost of the ballast water treatment systems is yet to be determined, but based on current quotations that are being made, estimates range from about $500,000 to $2 million for a ballast water treatment system. So that's a major capital expenditure that would need to be considered at the time of the next dry docking. Also, the next dry docking for these assets are special surveys. Special surveys are a higher standard of dry dock. They require a more stringent examination of the structural condition of the vessel and could result in steel replacement or decisions taken for coating or repairing ballast tanks, for instance. Those can be very costly. So you've got to add that capital expenditure. There are also upcoming emissions standards that are increasingly stringent that could apply to some of our assets. That would be another capital expenditure that would need to be determined. And I would say to you that our position historically and the position today is our ability to make those capital investments will be dependent upon the visibility of forward employment at the time of making those investments. Turn that around, if there is no visibility of forward employment and given the heightened uncertainty of the acceptance of these assets in the traditional trading market of petroleum transportation, it would likely be the case that we would choose not to make those investments and either repurpose the assets into some other sector or some other use or scrap the vessels.
It's helpful. Thank you.
Yes, sir.
Thanks. Adam Ritzer with RW Pressbridge. I guess getting back to the added vessels into the fleet, there's going to be 9 coming up, you mentioned.
2017, yes.
In 2017. So how many were there, let's say, last year?
Well, there have been, I'm sorry, I don't have the exact number, I can get it to you if you want, but to my recollection, there have been about 10 ships that have been delivered into the market this year, and there have been 2 deletions.
Okay, so you're going basically from 80 to 100, roughly.
That's a good, I mean, I would go back a little bit further, but yeah, if you look at the traditional Jones Act market, it was served by a universe of about 80 ships.
Okay, and you haven't really seen a decline in revenues yet, right?
The spot market has declined. Much of the revenue structure that we have embedded in our income statement is a result of contracts that were fixed in earlier years.
Okay.
So as those contracts run out and as we either renew or expose ourselves to the spot market, then the current rates would begin to have a more visible effect on the revenue side of our business.
The 63% you have covered for 2017, what kind of rates are those at? Are those still under your contracted rates? Have you seen future rates come down because they're going to be on spot market next year? Can you give us any color on that?
Look, there are analysts that provide indicative rates as to what they read the spot market at. I think I caution reading too much into those rates because the depth of the spot market is so shallow that the rates can swing very dramatically from really one fixture to another. But they are indicative of a level of expectation, and there have been certain published calculations as to the equivalent time charter rates of recent spot voyages that would indicate the round voyage return on those spot voyages at being in the high 30s or low 40s. That's clearly significantly down from, say, 18, 24 months ago when spot voyages were as high as $90,000 or $100,000 a day. So there has been a reaction to the increase in supply into the market. You know, I go back to the crude oil being the swing factor. You know, the significant driver in the shift in spot market rates has been, on the one hand, the decline in the demand for crude transportation ex Corpus Christi, serving both the Delaware Bay refineries, which that's no longer economical because the WTI Brent spread is closed that arbitrage opportunity, as well as serving the Gulf Coast refineries simply because of a drop in the actual production coming out of Eagle Ford. So that's freed up somewhere between, call it 7 and 10 ships in real terms that were being utilized in the crude transportation market and are no longer currently needed in that crude transportation market. And so those ships have bled over into the clean market and created an excess of supply in the clean market.
And then my last question is, with the 63% you have covered now, this time last year, how much did you have covered for 2016?
High 70s, I was going to get 75, 80%, something like that.
Okay. Okay.
We have renewed, I'm just trying to think backward. We've renewed this year probably 4 ships. So the rates are different and the sizes are different, but you know, 4 out of 24 is 1/6. Yeah. So I mean that's rolled off and renewed in this year.
Okay. Got it. Thanks very much.
Yes, sir.
My name is Richard Diamond, and I'm with Straight Line Capital. Let's move forward in the following scenario. Let's say oil production increases dramatically out of the Eagle Ford and we return to previous volumes. To what extent does the fact that we can now export oil change the dimension of what will move by Jones Act and what will be exported? Thank you.
That's a great question. And it's a complicated one to answer. You really need to go a little bit deeper into refining economics and refining engineering to start to unpack that. Eagle Ford crude is a very light crude, and therefore a refinery that is engineered to be able to refine light crudes in order to optimize the output of product through the use of that input is going to be the natural consumer of that product. A refinery that is looking to try and optimize its engineering to run heavier crudes is not necessarily absent an upgrade or a capital investment to change its refining engineering, going to be able to utilize light crudes. And if it's been set up to run heavier crudes tend to run pricing-wise at a discount to lighter crudes. So on the one hand, you can buy cheaper oil from, say, Venezuela, as an example, and run it through your refinery. And because the input price is much cheaper, then you're going to be economically incentivized to do that. And in order to change that slate, you would need to make capital investments into your refining mix, and you don't want to do that because you want to defer those capital investments. So you kind of keep going along the path that you're on, even though there's notionally cheaper, maybe cheaper from a transportation point of view, cheaper fuel closer to hand, that decision is a bigger decision than just buying Eagle Ford crude from Corpus Christi, for instance. The shift, if those things can shift around and can be influenced by other factors. You know, if you're a Louisiana refinery that's been traditionally running Venezuelan crude, well, now Venezuelan crude is dropping off like a stone, and the political uncertainty there is also large. So now you're sitting and you were thinking, I'm going to defer my capital expenditures. Now I'm worried because I'm not going to be able to get Venezuelan crude for the long term. So today I'm going to accelerate that decision to make the capital investments and shift my crude to a domestic, to a lighter crude, which would then favor your use of Eagle Ford, for instance. David St. Ammons writes this research work through a company called Navigistics, and does detailed analysis that takes into consideration API, ton-mile demand, location, refinery mixes, and these sorts of things. His conclusion is that the lifting of the export ban should have marginal, if any, impact on utilization of crude oil produced in the United States, that the economics should dictate that crude goes to domestic refineries, in all else being equal, right? But that's his conclusion. The empirical data on that is mixed. There has been an increase of exports out of Corpus Christi recently. Some people think that's experimental, just to try and see whether these crudes run better or worse in refineries that are overseas. Some of the South American refineries are more easily use lighter crudes than the heavier crudes, and so there's a temptation to try and bring that in. But at the end of the day, you have all these economic forces that are driving the market. And as I said at the early part of my presentation, trying to factor all those variables into a model and come up with the right answer, difficult. Yes, sir.
Loss carryforwards and impairments have been very prominent in your financial reporting recently. How should we think about those two components of EBITDA going forward?
Rick, can you?
Neither the impairment nor the tax loss carry forward are a component of EBITDA. They are outside of EBITDA. Sorry. The question. Red. Sorry. Hello? Oh, it does work. Okay. So the question was, how does the recent impairment or the tax loss carry forward come into the EBITDA calculation? And my response is that neither the NOL or the impairment are a component of the EBITDA. And if you look at the appendix, you will see that when we come down to adjusted EBITDA, we start with net income and we actually add back both of those items. So they are removed from the calculation. Okay.
So I guess we've exhausted the questions. So I want to take the opportunity to thank you all for coming. I was channeling Sally Field in her Oscars acceptance speech some years ago when she said, I can't believe you actually like me, but I can't believe that we have this much interest in our business. I find it really, really encouraging, and I hope we can stay in touch and deliver for you over the months and years to come. Thank you again.